Let's bring in our next guest, Sonia Meskin, BNY Mellon Investment Management, Head of U.S. Macro, as well as Michael Kushma, Morgan Stanley Investment Management, CIO of Broad Markets Fixed Income. Michael, I'm going to start with you. I mean, what stood out to you specifically on what we got from the FOMC statement? What are you going to be looking for in this press conference?
Well, I think what it reiterates is this idea of a very soft landing kind of economy, with the unemployment rate forecast being brought down, growth being upgraded significantly for this year and next year. All looks quite good. Why would you want to change interest rates if everything's going in the right direction of lower inflation, lower unemployment, and longer term? Rates are still targeted to drop as much as expected over the long term. That 2.5% terminal rate remains unchanged, so that we won't get as many rate cuts next year. We'll get maybe more than expected in 25, 26. So it's all a pretty benign, longer term view of things without too much stress. So if this forecast is accurate, you can see that without a meaningful recession, that risk assets, high yield bonds, emerging markets should do okay or well.
So, Sonia, Michael's saying maybe this forecast suggests a soft landing, so why mess with rates? Is that your take?
Well, I think the Fed, is never really, until we are clearly seeing a recession, is not in the business of saying we are going to go into a recession. Of course, they're going to, their central scenario is going to be to forecast a soft landing. It's their job to try their best to engineer that. I do think that this is a bit more of a hawkish message than maybe investors were hoping for. We do see this in the price action as well. Only 50 basis points of cuts next year. Certainly markets throughout this year were hoping for more cuts in 2024. They also solidified the view of another hike in 2023. And if you look at the dispersion around their forecast of the neutral rate, they're really moving towards forecasting a higher neutral rate down the road than they do currently. So I do think this is a bit of a hawkish message, and it reinforces the concern in the committee that they may have to do more to get inflation back down to 2%, as patient as they would like to be into 2026. There's still risks that unemployment is not just going to nicely stay around 4% and inflation come down on its own.